Welcome, everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning out there to all of our viewers and our listeners. Thanks again for tuning in. If it's Tuesday, we're talking real estate. We appreciate everybody joining us again, and I'm excited about our topic for today's show. I'm Barry Saywitz, president of the Saywitz Company and managing partner of Barry Saywitz Properties. And if it's one thing I've learned in my 30-plus years of doing this, it's to try and surround yourself with good people, gather as much good information as you can, and make good business decisions. And so for that reason, I'm excited to have our guest on today's show, Jerry Fink, founder and managing partner of the Bascom Group, headquartered here in Irvine in Orange County. Jerry, welcome to the show.
Thank you, Barry.
Yeah, so I appreciate you coming on. I'm excited because I know you are a real estate guru, have been doing this for a long time, and are deep into the investment side of things in all of the different sectors of the market, multifamily, office, industrial. I want to start with sort of how you got involved into the business, because you're a longtime Orange County guy and longtime real estate professional. So what made you get in the business in the first place?
Great question, Barry. I went to school at the University of Wisconsin. My undergrad was in electrical and computer engineering because my dad picked it. And I finished that, but I realized I didn't really like engineering. I liked business. So I went to business school at Wisconsin after undergrad and majored in finance. And every course I took, they said, the markets are efficient. You can't outperform the market. And I realized, well, why am I studying it if I can't outperform it? And I was at the gym one day and asked for a spot in a bench press. And this guy that spotted me said, hey, what's your major? I said, finance. He's like, well, I'm a real estate major. You should take a real estate class here as an elective. It's a great real estate program. And I thought, okay, that's a cool idea. I'll go take that. I took this real estate class. And the very first day I sat there and the professor said, here's how you make money in real estate. You buy low and sell high. I thought, wow, that is so deep. I'm going to major in real estate. So I double majored in real estate and finance. And I thought I'll just look for the best job I can get, graduation. It turns out that Wisconsin had this #1 rated real estate program in the country, and a much better program than the finance program. So I graduated, had much better offers in real estate than finance. And I so badly wanted to get out of the Midwest. It was too cold. And I had a job offer from Pacific Life Insurance Company in Fashion Island. So I flew out in December, landed at John Wayne Airport. I thought I had gone to like the promised land.
Yeah.
Beautiful women, expensive cars. Good weather. Stayed in Fashion Island and interviewed. I flew back. It was a blizzard. And I said, I'll take the job. I think it was like $46,000 a year salary. So I came out here in the 1990, which turns out was really the crash had happened. Right. I had no idea. I was a student in school, so I had no idea the whole U.S. had crashed, especially California. So I started working for Pac Life as an analyst, doing commercial real estate. We did loans, foreclosures, asset management. So it was a great experience seeing how the markets had crashed. And then I started buying little homes and duplexes and fourplexes after work on the weekends, and kind of learned the value add story on my own, and started doing that 94, 95, which was really a great time to do that. And I was good friends with David Kim and Derek Chen, who I went to school with at Wisconsin, the real estate program. And so Dave and I were talking about, this is a great opportunity. The markets have crashed, and I feel like if we don't jump on this, we'll miss the opportunity. So Dave and I put together a little business plan, 10-page, PowerPoint, and that was before PowerPoint existed. So we did it on Excel. We did this Excel business plan, and we thought we'll buy 500 units, and we'll each make we'll buy them, renovate them, sell them. We'll make $500,000 each and call it a day because we
go to the beach.
Yeah, we made so much money.
Right.
And so we put this little plan together and pitched it to some investors. And our first investor we pitched it to was Derek Chen, my other classmate at Wisconsin. And he after we're done, I thought he would say, hey, it looks interesting, I'll think about it. And then he'd turn it down. after it was over, we said, I'm in, I want to invest, let's do it. So in late 95, we quit our jobs. I was at Pacific Life, Dave was at Disney Development Company, quit our jobs, started Bascom, and turns out we picked an amazing time in 96 to start buying real estate in Orange County.
Yeah.
So it was really a great time.
Yeah, it's interesting because I grew up in the Midwest, and I love it there, but I would never go back, certainly not in the winter. And then I also started buying stuff in the 90s and the same deal, and started buying with duplexes and fourplexes. And you could do it then because you could get 80 or 90% financing because banks were trying to get the stuff off their books and make loans. A little different than maybe today's environment.
Exactly.
And so Bascom Group, so you start buying stuff, and your MO, you've grown the thing tremendously, and congratulations on all the success that you've had personally and with the company. And in today's world now, you're buying big stuff. I mean, you're buying big apartment complexes, you're building industrial, you have funds for different sectors of the marketplace. I guess let's just talk about how Bascom works in today's environment. You put together a fund, and then you bring investors, and then you go place that money and try and obviously make money on the money. I mean, that's my short version of it, but I'll let you give the official explanation.
Yeah, I'll give the official explanation, which is every acquisition we make, we typically get a bridge loan or some type of loan to purchase it, and it might be 60 to 75% loan to cost. So it's a loan to cover the purchase price plus a renovation holdback to cover renovations post-closing. And on the equity side, we typically partner with institutional investors. It could be a life insurance company, it could be a private equity fund. We've raised our own discretionary funds, so a variety of sources. Or it could be a wealthy family office. So, and those investors typically put up 90% of the equity. We put up 10%, and there's a preferred return, a profit split. And so we'll find the opportunity, pitch it to an investor, they commit to doing it. You know, they'll put up 9% equity, put up 10%. And then we'll buy it, reposition it, spend anywhere from $10,000 to $50,000 per unit doing this, minor to major upgrade, and then hold it 3 to 5 years and sell it, and then hopefully there's a profit that can split up, and we make our promoter profit sharing position if it works out great.
Yeah, and in the process of that, you manage the renovation, you manage the property, and so you're controlling it so that your investor partner is a passive investor. They're waiting for you to perform in terms of executing the business plan of that particular asset. And then I'm going to guess, assuming if it was me investing, I made money, you call me the next time, you'd be like, I got another one, let's go.
Exactly. Right? And that's the plan. So our investors are relatively passive. We're the ones doing the work, so we're hiring the property manager, we've got a construction manager, we're getting the financing, we're signing on the loan guarantees if required. So we're doing the entire process for the investor, and that's why we hopefully can earn that profit sharing position if it works out great. So our investor can make money, we can make our profit share, and everyone kind of does well, hopefully.
Yeah. And so over time, you started on the residential side and the multifamily, but you really forayed into really all sectors. I'm going to guess if there's a money and opportunity and it makes some sense, you'd go there.
Exactly. So I tell people my day job is value add multifamily. So our company here in Irvine, we have other offices as well. We're focused on value add, buying, repositioning, and selling multifamily throughout the U.S. But then over the years, we've started about a dozen different portfolio companies, and several are industrial, a couple have been office, we had a retail venture, we have a co-working company called Premier Workspaces. In every case, it's been the same. We try to find entrepreneurial people that needed our capital to get started. Salaries, office space, but they had the ability to find good deals and find partners to kind of buy and acquire those assets. Very similar to our business model, but they were doing something different, whether it was industrial or development or retail or office, some other different product type that we felt, hey, it's not competing against us, but it's going to enhance our growth as well.
So it's another level, right? I mean, they're finding deals for you, just
exactly.
No different than you're finding deals for your own investors.
Exactly.
And then in terms of working with the brokerage community, I'm assuming that you do that as well. They know you have money and you're out there and active. They bring you deals.
Yeah, the brokerage community is always our lifeblood. So our goal is to give them surety of close, and because if you're a broker, you want to bring the deal to someone that you feel they're going to close it, right? So We've got a great relationship, we think, with all the brokers out there, and that's how we live and breathe, is them sending us opportunities, every day. And they, whether it's off market, listed, it's a very competitive game out there to find a good deal today. So you need a great brokerage community to help you do it.
And so when you're finding these deals, do you find yourself competing against other institutional buyers or other well-heeled investors? I mean, the kinds of deals that you're working on today, I guess let's just talk about that. Right on the apartment side, what's a range of size of units? It's really on the bigger size of things, right?
Yeah, I'd say we will buy as low as maybe 50 units, but our niche really is that 100 to 400 unit zone for multifamily. And the reason for that is you start buying smaller deals and just the profit potential, the work, the fees, you kind of go, it wasn't worth it.
There's no economies of scale.
Yeah, economies of scale. And for us, it's a lot easier to buy a 400 unit building that's, $100 million than to buy a little 30 unit.
Right.
And the profit potential is much greater. So you go, well, I'm going to focus my energy on those versus buying little properties where the potential isn't that great.
Yeah. And so when you get into the bigger stuff, I'm going to guess, A, harder to find, and then B, when you do get there, the other buyers that are out there, for the most part, are all well-heeled as well. And so how do you separate yourself when you're looking at the deal? I mean, first is it's got to work for you.
Sure.
Then you got to be able to tie up the property and all of that. Or are people coming to you now because they know you, going, look, I'm just bringing it to you?
Yeah, they come to us off market, but then we also do a lot of unsolicited offers. So we'll say, hey, I like Garden Grove. Let's go target every owner in Garden Grove, send them unsolicited offers. Owners get these letters daily from brokers going, hey, can I sell your property? They throw them in the trash. But if they get a real offer, they're forced to go, well, should I take this? Should I counter? And then it creates a discussion that might not have occurred that if you just wrote them a letter saying I'm interested. So we try to send actual offers that are, it's 30.
So you put a number in there, right?
Put a number in there, and you go, how do you do that? Well, we've got access to all these rental databases, and we've got operating expenses, so we can get a pretty good idea what the NOI should be, just based on market rents, what we think the expenses should be. So we're pretty good at drilling in, maybe plus or minus 5-10% of what the property's really worth, just doing our own analysis without seeing any operating statements.
Well, and also you're doing the value add, right? So you're not going to come in I do it on a smaller scale, but I'm not going to come in and say, hey, this toilet looks like it's old, or this towel bar's fallen off the wall, or the roof's older. These things, right? Mm-hmm. So for the seller, he's just getting a number. You're going to write him a check quickly and get him out of the way, and he moves on with life.
Exactly.
And you're going to remodel it anyway.
Well, that's why people say what cap rate was, and I say sometimes, well, it's irrelevant because the rents were 50% below market. So we look at the cap rate, but it's not our most important criteria. For us, it's the total return over the whole period. Maybe that's an IRR that we're trying to hit.
Right.
That's our target. And, we like buying higher cap rates. It's easier to get financing. But, whether it's a 3, 4, or 5, it kind of doesn't matter. It's really our model we built. And can we move those rents to some higher level?
But don't you find, I go back to the 90s, right? When I first started buying stuff, I would buy stuff at a 6 or a 7 cap.
Sure.
And then I would say, hey, look, even if the cap rate stayed the same, if the market didn't move, if I could renovate, if I could raise the rents, if I could get better tenants and fix up the property, then my value would go up surely by just increasing the revenue.
Exactly.
Right? And you were buying it at today's cap of whatever that number was, 5, 6, 7, and then if you valued it when you were done, you'd be at the same cap rate. What happens is then over time you're buying on a future cap rate or a future return. You don't care about the cap rate, and then that gets applied to the next deal, which then drives the market up because the cap rate that somebody looked at it says, hey, this guy bought it at a 3 cap in a 5 cap market. Hey, guess what? And so it's interesting how that actually moves the market in the wrong direction if you're the buyer. But you need to make deals, and you don't care about the cap.
And we plug the cap rates in, but it's funny, the thing we most talk about is gross rent multiplier.
Yeah.
Very simplistic kind of test of, hey, what's the purchase price divided by the annual rents? And, we found that if you can buy something sub 10 GRM, it's probably a great deal. If it's high teens, probably doesn't work mathematically. So we have all these gross rent multiplier tests that we look at, very simplistically to go, is this a big picture a good deal or a bad deal.
And what's a typical hold time for a deal that you have? You said 3 to 5 years. Is
Sure.
that kind of what is? And then there's an exit strategy, which is I sell it, my partners get their money, I get some as well, and I go to the next deal.
Yeah, so we're probably a 3 to 5 year holder. And people say, why 3 to 5 years? Well, we buy it, the first year and a half, we're upgrading it, renovating, turning units, doing the exteriors. It takes another year to kind of move the rent roll up. And so by year 3, you argue, well, I've done everything, right? Other than just market growth, I've done my value add. And a lot of investors, they want to give you money, they want to see you execute the business plan, and they want to harvest it, make their return, split the profits up, and then go their separate ways. So
right, they're not the long-term holder. This is not my retirement
exactly. And
cash flow thing.
I'd say private investors a little different. Some may say, hey, I want to just refinance and hold it forever because it's more tax efficient. But I'd say the majority of investors, they want to see you execute the business plan, make a profit, call it a day, and then they move on, because a lot of them have limited life funds. Their funds are 10 years. And so the goal is go make investments, make a return,
keep moving the money,
and then move on, and they close the fund down, do another fund.
Which is great for you, because then it basically you're making money off the volume of the deals as well.
Sure. Yeah, it's all about at some point you have to kind of harvest your promote, right?
Right.
You make this profit, and maybe you have imputed equity, but
you got to prove it.
Yeah, how do you get back? So
and I was reading up and looking online. You guys have done something to the tune of close to $20 billion of transactions, and was I reading right that it's something like 90,000 apartments around the country?
We've acquired 90,000 units to date. That's about 330 communities. So we've been one of the more active buyers and reposition type groups in the U.S. doing that. And then that doesn't really include our development deals and other ventures we've done as well.
And all of that's run out of the Irvine office for the most part.
Exactly. Irvine's our headquarters.
Yeah. So, it's and I saw you guys are one of the, I guess, top 50 apartment owners in terms of volume and size-wise in the country. And that yielded for you accolades of Entrepreneur of the Year and also awards from right here at UCI from their Center for Real Estate as well. So
sure.
It's great stuff.
Yeah, thank you.
So I want to talk apartment market in today's world, right? So how is it different now? Interest rates go up. Volume of transactions seems to be slowing down. Everybody's a little more careful to make sure they're not making a mistake or that they don't buy at the wrong time or the wrong price. Are you doing the same, and are you seeing that?
We are. We're more cautious as well, because a year ago plus, we were in this 3 to 4 cap rate environment. You could borrow high leverage at 3%, 4%, next to nothing. Rents were going up double digit. It was this golden era of buying and owning real estate. And then probably April, May, the government started cranking up interest rates, and dramatically from near zero to, SOFR now is 4.6%. So a massive increase in interest rates. And then the fear of, this recession's coming too. So it's not just that, and then lenders get more cautious as well. So what's happened is the leverage is lower. So it went from 75% to 60-ish% leverage. So a lot lower leverage at a lot higher interest rate. And now you have the fear of, I'm not going to get these double-digit rent increases. They're going to be 2, 3, 4, if I'm lucky, going into this recession. So the whole outlook's changed. Your leverage is lower, your rate is higher, and now you're worried, are my rents going to be lower a year from now or 2 years from now if I go into this recession? So it's really changed the whole picture from a year and a half ago or so to a much more darker mood on, owning real estate. And, people still like multifamily. They don't like office anymore. So there's more capital flowing to multifamily, but people are more nervous today. And the cap rates are dramatically higher. It shocked me how much cap rates have moved up in Orange County today. They were 3s to 4s, and there was a building in Orange County brand new building up in Whittier, traded for a 5 cap rate, which you have never seen that.
Right.
And that's a Class A building. So, it probably gets worse from there. And I think a lot of sellers, there's been very little activity because sellers are shocked that are cap rates really that high?
Right, and the seller is still focused on yesterday's number, and so whether it's the buyer, whether it's you, or whether it's their broker, has to go tell them, hey, your property was worth X, it's not worth X anymore.
No,
and Y is less than X, not more, right? So you go from really quickly, almost in the flip of a switch, multiple offers, bidding wars, purchase price exceeding asking price to no activity, I need to take a haircut, right? And then the other issue I found, I'm curious what you see in your world, is that the perception of the market is as bad as the reality of the market. So if the perception is that it could get worse or there's a recession, not only does that affect your tenants when they go to renew their leases or their own mindset, but then it affects the buyer as well, which then further, I think, drives the prices down.
Exactly. And I think it's... I talk to our staff and I always ask them, hey, what are current cap rates today? And they tell me, and I'm like, that high? I'm even in shock how much it's moved up. And so I'm still in this, hard to believe it moved that much that quickly up. And, prices are probably down 10, 15, 20%, not just LA, Orange County, but nationwide, because you plug in this lower leverage loan at a much higher rate, that's the answer now. It's a lower price today. And you look at buying activity, and a year ago plus it was, hey, if you want to be the top bidder, you better go hard, non-refundable, $1 million to get the deal, right? That was a common, action on probably
doing stupid things just to get the property tied.
2/3 of the deals you had to go non-refundable, a large amount of money pre-due diligence. Now that conversation doesn't occur. They're kind of happy you're bidding on it today. So the whole world has changed dramatically.
And you go from this ridiculousness of this crazy market to really what should be a normal market. I mean, in a normal market, I ask $1 for something, you offer me 90 cents. We haggle, maybe we settle at 95 cents.
Exactly.
Not, I say, I don't even know the price, but it's definitely not less than $1. Why don't you make something up and give me some money and do some other weird things?
Oh, yeah.
Right?
I mean, a year ago was, I'm asking $1, but I'm going to offer $1.05 and go non-refundable and close in a month.
Right, and not ask any questions and just deal with it.
Exactly.
So are other parts of the country the same as what we've been experiencing here in Southern California? I mean, we have some dynamics here that I think are much different in terms of not only the property value and the rent growth being much higher, but also with just the legislative, with rent control and other things. Do you find that it's more difficult in other parts of the country?
It's much easier, and I'd say, as we talked about, LA in the Bay Area may be the worst markets of just toxic ownership kind of actions by the cities and tenants. You go to Florida, Texas, Arizona, it's a free market, pro-business environment. And if you're in LA in the Bay Area, it's, well, A, no one's paying rent, or B, you can't evict anybody still. And so it's been a very negative, dark environment in those markets. Have rents gone up? Yes. Are the vacancy rates low? Yes. But, anywhere from 10 to 30% of a building in LA in the Bay Area is not paying rent currently.
Yeah, it's crazy.
And hopefully in March that ends. But it's been a crazy 3 years of, if you've owned in those markets, it's been very painful of huge delinquency rates.
And so why, I'm going to ask the question, why would somebody continue to own in those kinds of markets versus just go to Florida? The weather's still nice, and I don't.
Pro-business.
Right. I mean, I have a governor who's pro-business. I have just an overall environment that is much easier to deal with. Why? And what are you hearing from your investors, and why would you stay?
Well, it was interesting because I went to maybe a year or so ago, and it was a group of about 40 CEOs, and they spent an hour bitching how awful owning in LA was, and about this, lawsuits, tenant rights, advocates. No one's paying rent. I can't evict anybody. And after an hour, the moderator says, well, would you rather go buy in Phoenix or Texas? They all said no. I said, why? I said, well, at least if you buy in California, LA, Orange County, or Bay Area, you feel like if I buy something here, even if I buy it wrong, 10 years later, I'll make money on it because high barriers to entry, low vacancy rates, and as much as all these people are difficult on you, it actually discourages new construction. So the market stays tight and strong and rents go up, and you feel like 10 years from now, I'll be glad I bought it.
And that's a common theme, and we've talked to other guys that have been on the show about it, is if you're in it for the long haul, then while California has certainly its more than fair share of difficulties and large swings in property values as the market shifts, more so than Texas or Florida, but at the end of the day, you'll do better in California if you can accomplish the barrier entry and get in, and if you have the stomach to hold it. If you don't, it's much easier to go someplace else and just not have to worry about those giant fluctuations and all the other problems.
That's true.
So in terms of your company's appetite and desire to buy in today's world, have money, looking for the right deals, and is it multifamily? Is it industrial? Is it retail? I mean, are you still, if the deal's there, certainly you'll execute?
Yeah, for multifamily, that's still our primary focus. And but it's a real challenge today because, as you said, the sellers are in shock that cap rates moved up that quickly. And, a lot of sellers think, well, I'm just going to wait. Maybe rates will go down. Cap rates will go back to normal, whatever that is. But
which is interesting because I thought 5% was normal and I thought 3 was low, right? And I thought 7 was pretty good. But then the problem is people have a short-term memory, right? And they go, hey, 3% cap, like that. Oh yeah, that's a good.
I mean,
that's a stupid number.
It was only a year ago. It was a 3-ish cap rate,
and you weren't buying on 3, and I wasn't buying on 3 for a long-term hold of 3, right? So the dilemma I've got is I'm a long-term holder, and then broker would pitch me the deal and say, well, you could buy it at a 3 cap, but then you could fix it up, and then you could raise the rents, and then I go, and then what do I get? 4.5, right? I mean, that's not attractive. I get that in the bank today.
Exactly, and that's a big challenge today. Is that people can buy these CDs at 5%, and you start going, well, they're federally tax free, so why even invest in real estate? I'm going to put my money in CDs right now. And what's happening is people are pulling their money out of the banks because they can't earn a good enough rate.
Right.
And the banks now are having big withdrawal issues, and loans aren't being paid off. They can't make new loans. It's put kind of the lending environment in a little bit of a quirk right now because of this whole, CD rates are so attractive that why keep my money in a bank earning, 1% or 0.5%?
No. It's certainly a challenge. And so where do you see the markets going between, at least just now and the end of the year? I mean, there is rumor of 1 or 2 more rate hikes. Maybe they stop. Maybe they just keep plugging away. What's your thoughts on where the market goes? Are you going to see more of the same, just slow?
I think it's going to be slower. And the biggest problem really is the debt financing. It's lower leverage, it's higher rate. Now, I say that's the negative. The plus is people have been burned in office buildings. They don't like retail. They're nervous about hotels. Industrial's hard to do if you're an investor, especially a private investor. So multifamily, what I've seen is more capital flowing toward multifamily because it's the one product type people go, oh, if we go into recession, I'm going to do okay. I'm not going to get damaged like I might in an office building. And so
little do they know, right? The people have to pay.
They got to pay rent, and rents have to keep going up.
Right.
So I see more. I still see more capital flowing to multifamily, and there's always Freddie and Fannie, so you have great financing sources. So I don't see a crash in multifamily. I see rent growth moderating to maybe 3-4% this year, from the double-digit rates we've seen for a year or two. So,
and do you see that the supply demand, for lack of a better word, trumps the fact that, I mean, you've had this steep rent increase for renters, but there's still a limited amount of supply out there. So if I am out there looking for an apartment, there's not tons of stuff for me to pick from.
No, that's the one plus and minus about Southern California. It's very difficult to build. It takes you 4 or 5 years to get something built, assuming you got the approvals and financing. And so, the risk of new supply is pretty minimal here. So if you buy your own apartment, the risk I'm going to get overbuilt, a pretty minimal risk. Now, you buy in Dallas or Phoenix or Florida, that's a real risk today that they build too much, and they probably will build too much in the next year or so, and rents might go negative. But in California, it's just rare to see too much supply hit.
And you're land constrained, right? And so somebody'd have to knock something down to build something new, as opposed to Florida, you could just keep going.
And they will buy office buildings, they'll buy small commercial and build multifamily. But by the time you buy some other old product type, build a new building, you might be $450,000 to $550,000 per unit, right? It's a very expensive proposition. And if you could buy something at $250,000, $300,000 a unit, you're a big discount to replacement cost.
Yeah, no, I agree. So I said before we got started, it would go quick, and we are out of time. We could go all day with this, and certainly love to have you back. We'll pick a different topic, whether it's rent control or industrial or other things, and pick your brain. But I do appreciate your insights and your input in the markets, and certainly wish you continued success for you and your family and your business. How do people find you or reach you if they want to get more information on Bascom?
They can go to our website. It's bascomgroup.com, and our contact information, bios, history's on there. So if they have a deal or interested in investing, just reach out to us, and we'll do our best to help you out.
Great. I appreciate it, as always, and your expert advice and opinion is well received. And so for those folks out there that are thinking about multifamily, you've got it right from the source. I think long-term, Southern California, long-term Orange County, good investment. Be careful out there. Make good decisions. I am Barry Saywitz, president of the Saywitz Company, and thanks again for tuning in, and thanks to everyone here at OC Talk Radio as always. We'll see you again next week on Tuesday for Let's Talk Real Estate. Thanks for tuning in.
There you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California Irvine's Beale Applied Innovation Center.